Welcome to my channel, CA Exams Academy, and today we are going to deal with a very important topic, that is forecast versus projection. Look, client tells you next year our profit will be 100 crores. Another client says if we open up 10 branches, profit could be 100 crores. Both sound similar, but for CA, they are completely different worlds. Welcome to forecast versus projection under SRE 3400. As a CA student, you will deal with future financial data, loan proposals, startup valuations, business expansion plans. But here's the key, not all future information is the same. What is a forecast? First, you have to know that. A forecast is based on best estimate assumptions about the future. These are realistic, they are most likely to occur, and based on current trends. Example you can take for forecast is, a company says last 3 years growth is 10%, next year expect a growth of 12%. This is a forecast because it is logical, trend-based, and achievable. What is projection? A projection is based on hypothetical assumptions. These are what-if scenarios, not necessarily realistic, conditional in nature. Example you can take, a company says if we expand into 10 countries, if demand doubles, then our profit will increase to 100 crores. This is a projection because it depends on condition. It is hypothetical. You can say projection is based on hypothetical assumptions and may not occur. Forecast versus projection, the core difference. Basis of forecast and projection. Okay. Forecast is based on the assumptions which are best estimate, and the projections are based on assumptions which are hypothetical. The nature of forecast is realistic, whereas the nature of projection is conditional. Purpose of forecast is normal planning, whereas the purpose of projection is scenario analysis. The reliability on forecast is higher than the projections. Example, we can say expected sales growth if expansion happens. Okay. Real life, let's take some examples to understand. Case 1. Sales expected to grow 15% based on past trends. This is forecast. Case 2, sales will double if company enters foreign market. This is projection. So auditor's role under SRE 3400 is where we have to give the focus. As an auditor, you must evaluate the assumptions, check consistency with past data, verify calculations. And this is very important point. You do not certify whether the results will be achieved. So different approach for each. For forecast, check realism, compare with historical data. For projection, check logical consistency, ensure assumptions are clearly disclosed. Students write in examinations, projection is unrealistic. That is also wrong. Correct approach, projection is based on hypothetical assumptions, not necessarily unrealistic. So we can in SRE 3400, the distinction between forecast and projection is not just theoretical. It defines the auditor's approach. While forecasts demand validation of realism, projections require evaluation of logical assumptions. As chartered accountants, our role is not to predict the future, but to ensure that whatever is presented about the future is built on sound and transparent foundation. Forecast tells what is expected, projection tells what is possible. Thank you.